You're 38 years old. You know exactly what you want: a secure, guaranteed corpus for your daughter's education 12 years from now. You don't want market risk, so you've made the decision to buy an endowment plan. But here's the problem. You've been shown 3 different endowment plans by 2 different agents. All of them show you a maturity benefit. None of them explains how to actually compare them. If you're wondering how to find the best endowment plans in India in 2026, you need a system to cut through the sales pitches and pick the best one for you. I'll give you 5 specific things to check to pick the endowment plan that suits your needs. Let's get straight to it. To find the best endowment plan for your situation, you need to check 5 things. The guaranteed maturity benefit versus the total premium paid. The bonus structure, whether it's reversionary bonus versus terminal bonus and how they're declared. The insurer's solvency ratio, the premium payment term relative to the policy term, and whether the sum assured is adequate as life cover alongside the savings goal. The absolute most important check is calculating your guaranteed multiple. You simply divide the total guaranteed maturity benefit by the total premiums you will pay over the life of the policy. Now, let's put your numbers into this. Say you pay 1 lakh a year for 10 years. That's 10 lakh rupees paid. If the guaranteed maturity benefit is 14 lakh rupees, your multiple is 1.4 times. For most endowment plans, this multiple sits between 1.3 times and 1.8 times over a 10 to 20 year term. Now, you might see a higher payout number. That is because those illustrations include non-guaranteed bonuses. But according to IRDAI's benefit illustration regulations, insurers are required to clearly distinguish between guaranteed and non-guaranteed benefits on the illustration document. While bonuses are great, you should only ever use the guaranteed component for your non-negotiable goal planning, like your daughter's education. That brings us to check 2. If you are looking for the best guaranteed return insurance plan in India, you need to understand how the non-guaranteed bonuses are actually added to your policy. There are 2 main types of bonuses. First is the reversionary bonus. This is declared annually as a percentage of your sum assured. The magic of this bonus is that once it is declared and attached to your policy, it becomes guaranteed. It cannot be taken away. Second is the terminal bonus. This is a one-time bonus declared only at maturity or in the event of a claim. It is not guaranteed, and it varies significantly from insurer to insurer. This is why an insurer's consistent bonus declaration history matters far more than a headline bonus rate in any single random year. Check 3 is the insurer's health. An endowment plan is a 15 to 20 year commitment. The financial stability of the company you choose matters far more here than it does in a short-term product. You need to check 3 metrics. First, the solvency ratio. IRDAI mandates a minimum of 1.5. But you should look at the 3-year trend in IRDAI's annual report to ensure stability. Second, their claim settlement ratio specifically for life insurance claims. Third, look at their bonus declaration history. Has their reversionary bonus rate been consistent, or has it been steadily declining over the last 5 to 10 years? For instance, Aditya Birla Sun Life Insurance publicly maintains its solvency ratios, claim settlement records, and bonus declaration history, so policyholders can verify this long-term stability. Let's look at the final 2 checks on your list. Check 4 is your premium payment term. You have 2 choices: regular pay, where you pay for the entire policy term, or limited pay, where you pay for a shorter period. Limited pay means a slightly higher annual premium, but your premium obligations stop well before the policy matures. For a specific 12-year goal like your daughter's education, freeing up your cash flow early can be incredibly useful. Check 5 is your life cover. If you are buying a savings plan with guaranteed returns and life cover in India, you need to check if the life cover component is actually adequate. The sum assured in an endowment plan is typically lower than what you would get in a pure term plan. You need to check if that amount covers your family's protection needs, or if you need to hold a separate, standalone term plan alongside it. If you're ready to start comparing, ABSLI's endowment plan options can be fully evaluated using this exact 5-check framework. You can find their guaranteed benefit illustrations and bonus history directly on the website and get a customized quote through the link in the description below. Now let's answer a few common questions. How do you calculate the effective return on an endowment plan in India? The most accurate way is to use the IRR or internal rate of return function in a spreadsheet. You list your annual premium payments as negative cash flows and the guaranteed maturity payout as a positive cash flow in the final year. This gives you the exact annualized percentage return. Is the maturity amount from an endowment plan tax-free in India? tax rules change. But currently, maturity proceeds from life insurance policies are generally tax-free under Section 11 Red, with Schedule 2 of the Income Tax Act 2025, previously Section 10-10D, provided the annual premium does not exceed the prescribed limit, like 5 lakh for policies issued after April 2023, and the sum assured is at least 10 times the annualized premium. Always consult a tax advisor for your specific case. What is the difference between a participating and non-participating endowment plan? A non-participating plan offers 100% guaranteed returns with zero market linkage or bonus dependency. What you see on day one is exactly what you get. A participating plan offers a lower guaranteed base but allows you to participate in the insurer's profits through non-guaranteed bonuses, giving you the potential for a higher overall payout. Use this framework. Ask the agents the hard questions. Secure that education fund with confidence. I'll see you in the next video.